In the 1920s, the American stock market was climbing toward historic highs, yet participation was almost entirely reserved for the ultra-wealthy. At the turn of the century, only about 1% of Americans owned stocks. The vast majority of the public was effectively locked out. For an average citizen looking to invest, the primary option was a closed-end fund. These funds were often traps. Managers frequently hid their specific holdings and used speculative borrowing to chase risky returns. Most importantly, they refused to buy back shares. If you needed to cash out, you had to find another investor to buy your position, usually at a price far below what the assets were actually worth. Edward Leffler, an investment salesman who worked directly with families at their kitchen tables, saw the result of this system. He realized that there was no reliable path for a working family to capture the growth of the broader economy. This lack of transparency meant that while the stock market expanded, the benefits of corporate equity remained difficult for the middle class to access safely. To solve this, Leffler and his partners founded the Massachusetts Investors Trust in Boston in 1924. It was an alternative to the era's predatory practices. This diagram shows the innovation, the open-end structure. Unlike its predecessors, this fund pooled smaller investments together to buy a transparent pool of diversified, secure securities, like utilities and railroads. They used a mechanic called net asset value, or NAV. Because the fund guaranteed it would buy back shares at the end of each day for the exact underlying value of the stocks, investors no longer had to worry about predatory secondary markets. Suddenly, professional management and market liquidity were available for a fraction of the cost previously required. The Massachusetts Investors Trust provided the first functional template for a financial technology that was designed to protect the individual investor. That protection became vital after 1929. The stock market crash and the ensuing Great Depression devastated public confidence in the entire financial system. In 1940, the government proposed a massive 100-page bill to regulate the industry. It included strict caps on fund sizes that many feared would make the mutual fund model impossible to sustain. Instead of fighting the regulators, industry leaders at MFS collaborated with Congress. They helped draft a compromise that prioritized the safety of the shareholder. This collaboration resulted in the Investment Company Act of 1940. It established federal standards for disclosure, corporate governance, and ethical responsibilities. By codifying these rules, the industry gained a permanent framework for trust, which allowed the market to begin expanding again. After World War II, the American middle class grew rapidly, and millions of families began putting their disposable income into mutual funds. But the industry was reaching a physical limit. The manual ledgers and paper-based accounting systems of the time were struggling to keep up with the volume of millions of new transactions. As paper systems reached their limit, the industry adopted mainframes running COBOL, eventually moving to personal computers and relational databases in the 70s and 80s to automate the accounting process. During the 1990s internet boom, online trading caused transaction volumes to skyrocket, pushing legacy systems to their breaking point. Today's solution is a shift toward cloud-native, AI-powered platforms that provide real-time calculations, instantly organizing this massive influx of data. These invisible leaps in back-office technology are what allowed the system of accessible finance to survive its own growth. Today, the mutual fund industry holds more than $33 trillion in U.S. assets. That original 1924 structure became the foundation for almost every modern savings tool, including 401ks, IRAs, and today's ETFs. This framework has opened the markets to over 120 million individual investors. Recent data shows that for households who purchased their first fund after 2019, nearly 40% are people of color, double the rate seen before 1990. Even as the industry moves toward distributed ledgers and robo-advisors, the core principles of diversification and accessibility remain the same as they were a century ago. The mutual fund transitioned the mechanics of the stock market into a tool for the individual. By standardizing diversification and transparency, it created a system that now supports the financial